When it comes to investing your hard-earned money, there's always a plethora of options to choose from, whether it's stocks, bonds, real estate, even cryptocurrency. There's a lot of different options and they all carry different risks versus reward. However, there's one option that often gets overlooked, but can provide stability and peace of mind throughout your portfolios. Now what I'm talking about is certificates of deposits, commonly known as CDs, and in this video we're going to explore exactly how to purchase CDs through Fidelity, show you exactly how to do it, and the massive yields that are being offered as of currently. But before we get into all that, make sure to please drop a like down below and subscribe for more future content like this. Now first off, before hopping over to Fidelity, let's go over what CDs or certificate of deposits actually are. So certificates of deposits are a type of financial product offered by banks and credit unions. Now they are considered to be one of the safest and most conservative investment options. Now when you open a CD or buy a CD, you are essentially lending your money to a bank for a fixed amount of time, and in return you'll receive a guaranteed interest rate. So now heading over to fidelity.com, right now we are actually in my brokerage. So how to navigate to this page, you would just hover over news and research, and then go down to fixed income, bonds, and CDs, and it'll bring you right here to this page. Now from right here, you can see all sorts of different things. You can see all the different offerings, such as CDs, it says new issues, which we're gonna be going over today. It says bonds, US Treasury zeros, agency, GSE, corporate, AAA, corporate AA, corporate A, corporate BBB, municipal AAA, municipal AA, municipal A, and taxable municipal. Now the cool thing with the Fidelity brokerage is they have it all laid out pretty good. It's very, very simple, which I like. I'm sure other brokerages might have this the same way, and I can't really speak on other brokerages, but I'm sure they all have sort of a similar way of doing stuff. Now in this video, we're going to be going over how to purchase a new issue CD from Fidelity. So we're pretty much only worried about CDs right here. Now through this, there's different months available, and this is how long it's going to take for the CD to basically mature. So we have 3 months, 6 months, 9 months, 1 year, 2 years, 3 years, 5 years, 10 years, and then sometimes there's 20 or 30 plus years. Now, as you see, there's going to be different yields offered depending on how long the duration of the CD is going to be, and this is going to be based on different things like the future potential of interest rates and the risk versus reward the bank's going to have and the opportunity you as the investor is going to have on these different durations. Now, for this example, let's go to the highest amount offered currently, which is 1 year of 5.65% CD. Now, once you click into here, it shows a bunch of different information, which might be a little bit confusing at first, but I'll go over everything. It says CD new issue offerings. Certificate deposits are debt instruments offered by commercial banks, thrifts, and brokerages to raise funds for their business activities. It then says minimum investment amount is typically 1 CD, which is typically $1,000. You can also buy fractional CDs, but for the sake of this video and what I normally do, we're going to be going over CDs in whole amounts. All broker CDs listed below are FDIC insured as indicated by the attribute. FDIC insurance covers up to $250,000 per issuer per category of accounts, or up to $250K in qualifying retirement accounts. Note that FDIC insurance only covers the principal amount on the CD and any accrued interest. In some instances, CDs may be purchased on the secondary market at a price, which reflects the premium to their principal value, and the premium is ineligible for FDIC insurance. So now heading down to all the different CDs that are offered at the 1 year time frame, because remember that's what we clicked on a minute ago. So as of right now, they are being sorted by the highest amount of yield to the lowest amount of yield. So the coupon is going to be the same as yield when it comes to CDs. 5.65% is what the yield is as of currently for the top yielding CD in this specific time frame. So starting all the way from the left, it shows a different bank or brokerage or whoever is offering the CD. So in this case, the number one top yielder is going to be JP Chase, which is very familiar. Now there's all sorts of different banks down here. Some of them might be banks that you've heard of, some of them might be banks you've never heard of. Like for example, Morgan Stanley, we have Bank of America. There's also often smaller banks that might not be as familiar. Now next we have the coupon frequencies. So this is going to be how often you're going to be paid from the investment. So most of them are going to be at maturity, which means that in theory, if you invest $1,000 on a 1 year CD that's offering a 5.65% yield, you are going to get paid your money back, the $1,000, plus whatever interest you earn in the CD at the time of maturity, which in this case is going to be around a year away from the settlement date or on the maturity date of 9/20/2024. Now, as we scroll through, there are some that offer monthly distributions, but for the most part, what I've seen and dealt with is at maturity coupon frequency. Now, next you're going to see the maturity date. Now, of course, your maturity date is going to be much further and much closer depending on what duration you go with, but again, in this case, the maturity date is 1 year away, more or less. Now then it says fractional CD. In this case, these are not offered in fractions. We have the yield, which is 5.65%, which is, side note, absolutely incredible that a 1-year CD is offering this. Next, very important, it says call protection. Now, call protection is basically giving the bank or the underlying issuer the option to basically call the CD in early. Now, for example, for this JP Morgan, they have multiple different call dates. The next call date specifically being right around 3 or 4 months away. Then from there, they have 1 month call dates from there. Now, the reason banks would want to have call dates built into their CD is because if interest rates go down and if they find themselves paying out way more money than they'd want to, in that case, they can call your CD away, pay you out to your underlying, any interest in the time frame before it was called away, and you get your money back and you're basically on your way. Now, some investors, of course, hate the idea of having your CD be called away because if they lock themselves up into a really high yield, they want to get paid the yield, of course. But as you can see, everything has a price. You can, of course, get call protection and get paid a 5.5% yield, which is lower than 5.65%, but you will have call protection, which means your CD is going to be locked up for the whole year and you don't have the risk of getting called away. Now, for me specifically, I don't really mind either way because whenever I'm investing in CDs, for the most part, it's going to be with idle money that I would pretty much have in a money market otherwise. But if or if not a CD being call protected is important to you in your specific situation, that's definitely another thing to consider. Now, the settlement date is going to be when the CD basically goes into effect. So today, as of right now, filming this video, we're a few days before the settlement date. So if I were to buy up some JP Morgan Chase CDs, which I actually did today, they're not going to be settled until the 22nd, which is around a week from now. Now, the quantity available is going to be how much the bank or whatever is selling. And as you can see scrolling through here, most of the bigger banks have massive amounts of quantity available, and then some of the smaller banks might only have a little bit. Now, under attributes, it's going to be the insurance or whatever is going to be covering the CD, like we read up above, FDIC, for example. And there's all other sorts of insurance, and definitely look deep into all the small print before you buy CDs. Make sure you know what you're buying. Now, as far as the period goes, most of these are 1 year. There's some 10 months here, but for the most part, whatever you click on earlier on in the brokerage, you're going to see all the same as far as period goes right there. Now, for this example, let's say we want to buy some of these JP Morgan Chase CDs that mature around a year from now that don't have call protection, keep in mind, but we're really hungry for that 5.65% yield. We would then click on buy. Then from there, it would take you to this page where it shows everything. So then you would click on your account, your trading account, or your brokerage account. It shows a CD from Chase offering a 5.65%. It shows the coupon frequency, the time period, the yield, and everything else. Now right here, this is one of the confusing parts to me when I first started buying CDs through the brokerage. I'm going to say one bond equals $1,000 face value. So if you want to buy $2,000 worth of CDs, you would not type in 2,000 because as you see right here, that would cost $2 million. If you wanted $2,000 worth of CDs at the 5.65% from JP Morgan, you would just type in 2 because one bond equals $1,000 face value. So let's say you want to go with 2, you would then type in 2, preview order, and then finish it. And then from there, it's pretty straightforward. You are going to see it in your activity tab in Fidelity, for example. And again, I don't know what it's like for other brokerages, but in Fidelity, you're going to see it in your activity tab and watch closely because the closer it gets to the settlement date on your activity tab, it's going to change on how it looks. But there we have it. It's as simple as that. That's exactly how you buy brokered CDs through Fidelity. And like I said, some of the rates that the banks are offering as of recently because of interest rate hikes are absolutely incredible. Earning over 5%, much less 5.65% risk-free from JP Morgan is definitely something worth looking into. But if you enjoyed this video and you want to see more videos like this in the future, make sure to please drop a like down below and subscribe for more. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.